Online students.
How okay, miss?
Online students who also, if you have any questions regarding the things that I'm discussing, you can raise the questions. No worries. Right. Okay. So then what it does, you need to confirm retention ratio is 60% and then calculate the dividend growth rate. Right? How you can identify the dividend growth rate here? Dividend growth rate, just we'll calculate quickly the growth rate, dividend growth rate. Dividend growth rate equals retention ratio. Yes, what is it? This is dividend growth rate. G equals retention ratio multiplied by the ROE. Right? ROE return on equity. Right? How you can identify the retention ratio? If company earns 1 rupee, they can decide how much of amount that we are going to retain within the business, plus how much of amount that we are going to share among our shareholders as the dividend on its payout. Right? So therefore, if you have given the retention ratio, definitely you can have the idea regarding the payout ratio plus the other one. If you have been given the payout ratio, definitely with the knowledge of this equation, you can calculate the retention ratio. In this question also, we have been given what? The payout ratio. Retention ratio is given to you. Quickly tell me the payout ratio of the company. Okay, calculate the payout ratio of the organization. Payout ratio of the organization. How much is it? If 1 equals retention ratio plus payout ratio, you can calculate here.
Yes, ma'am.
Retention ratio plus payout ratio. Payout ratio. Right. Here, payout ratio is how much? We don't know the payout ratio, that is X. We don't know the payout ratio, that can be named as X. This is X, and then we know the retention ratio, RR. How much is the RR? That is 60% or 0.6. Right? The rupee that we earn equals and is 1. So then how much is the payout ratio? X equals 1 minus 0.6. That is the payout ratio of this company. 0.4 or else 40%. 40% but payout ratio. Payout ratio. Right. Okay. So let's how we can identify the growth rate of this company? Yes, growth rate. Yes, exactly. Growth rate of dividend equals ROE, return on equity. We have a comprehensive idea regarding ROE in the capital structure. ROE, and then the other one, retention ratio, RR. In the particular example, ROE that is 0.1. 0.1, and then the other one, RR, retention ratio, it has been given as 0.6 or 60%. Right? If you multiply the 0.1 with the 0.06, the answer is growth rate is 0.06 or else 6%. Therefore, we can name the dividend growth rate, it is 6%. 6%. Hope you did the calculations. Any doubts here? Any doubts here? If company earns 1 rupee, they have the chance to decide how much of amount that we are going to retain within the business, plus how much of amount that we are going to distribute to our shareholders on the earned 1 rupee. Right? In the particular example, the company earned 1 rupee. They decided they need to retain the 60% of it. Right? That means the other way around, how much is the payout one? That is 40 or 0.4 on the earned 1 rupee of the company. Right. So with that information, we can calculate the growth rate of the organization. Growth rate of dividend equals retention ratio multiplied by the other one, RO. Right? ROE, how much is here? ROE, that is 10%. And then retention ratio, that is 60% or else 0.6. By multiplying 0.1 with 0.6, you can have the dividend growth rate, that is 0.06 or else 6%. That is what we have discussed here. Right. Okay. Okay. The next one. Calculation of the required rate of return or as the R. right? Estimation of R. We previously identified estimation of growth rate or estimation of G. Now we are moving forward to calculate the R or as required rate of return. What do you mean by required rate of return? So what did we get? Have taken this R or as required rate of return. So far we did lot of calculation. For what we have taken the R or else required rate of return. Yes. Yes, bond valuation, in bond valuation, share valuation. We have taken the required rate of return. For what? Exactly, to convert the future cash flows into the present values, we have taken the required rate of return or else the R, right? So we have another lesson called the cost of capital to calculate this R for each and every scenarios, bond valuation and the other things. In here, just we'll identify based on which model. Based on the constant dividend growth rate model, if we isolate R required rate of return, you can have the idea regarding R equals DIV1 divided by the value of per share plus the growth rate of that dividend. Right. So what is this? Again, based on the constant growth rate model, if we isolate the required rate of return, R equals DIV1. What do you mean by DIV1? Dividend in the next year. Dividend in the next year divided by the calculated value of the share. You have to add the growth rate to the calculated amount. So then you can have the idea regarding or a calculation regarding the required rate of return or as the R. Okay. We practice both growth rate and the required rate of calculation via question number 6. Read the question number 6. Read the question number 6 and then summarize the information given there. Okay, try to do this one. Calculate the R. Discuss with your friends and then do it. Calculate the required rate of return R. First paragraph is regarding the information for what? Information for the calculation of. Very good. That is the calculation of growth rate, right? Have you calculated the growth rate? Yes. How much is it? How much is it? Growth rate is 0.09. Growth rate equals ROE, return on equity. ROE multiplied by the retention ratio, RR, retention ratio. Right? ROE here 0.12. Retention ratio 0.75. So then the growth rate is 0.09. Or it's the other way around, that is 9%. Right? Okay. With that information, you can calculate the R. Required rate of return. R equals, as per the constant model, it equals dividend divided by value plus growth rate. Tell me what's the dividend one? That's the point where you have taken that's the other way around. You didn't calculate this is one, this is dividend. Okay? So then what's the formula? For the calculation of R, what's the formula? Yes, what's the formula? What's the formula? Yes, we identified it previously. What is it? What is it? That is DIV1. DIV1 divided by the required DIV1 divided by the value and then plus the growth rate. Calculate this is not DIV just by dividend, it should be DIV1. Right? What's the DIV1? 5 multiplied by 1 plus growth rate 0.09. divided by 40 plus growth rate 0.09. Now calculate the required rate of return. Why? This is the just paid dividend. You have given just paid dividend. Okay, dividend just paid. And in all CIV 0. What do you need? You need CIV 1. How you can calculate CIV 1? Just paid dividend plus dividends are now growing with the rate of 1 plus r to the power n, or 1 plus growth rate to the power n. Here, what's the value? CIV1. CIV1, how much is it? Next year dividend. 5.45. 5.45 divided by 40 plus 0.09. What's the value? R equals 19. R equals 19.26. 26 to that. What's the value? 19.22. Right, 19.22.625. 22.06. Okay. So we have already expected. Now the second valuation method for the ordinary shares. What is in method 2? Make the heading method 2 price multiples. Make the heading. This is method 2 price multiples. Method 2 calculation of the ordinary share price according to the price multiples. What's the method number 1? What's the method number 1? Dividend discount model. Second method, price multiples. Very good. Hope you all are clear and you are in the track. Okay. Compulsory question is there? No, anyway. Anyway, did you go to the past papers? 17C. It's very easy paper. Past papers that. Okay. Let's go to right multipliers. So far in the dividend discount model, what we have taken the cash flows. Right? We taken the cash flow as the base and then converting the cash flows into the present context and then identify the value of the share. That is what we have done. Price multiple is a separate method. Now price multiple is identified. Already we have calculated average ratios for organization. Based on that ratios, we are going to compare with the market price. We are going to compare the EPS and we have some numerical metrics with regard to the EPS and what will be the market price. Right? With regard to the book value per share, what will be the market price? With regard to the NPVs, net profit per share, what will be the market price? So that is likewise what we are doing here. We compare the two values, right? We have already calculated standard. So those are average base, those are historical base, right? So based on that historical ratios, we were given the values for the shares. With the ratio and then with the given price of the values of given multiples, given values, we are going to have the idea regarding what would be the market price of a share based on these numerical metrics. That is what we are going to identify in the price multiples. This is a comparable method. No any cash flow calculation, no any present value calculation. With compared to the other industrial metrics, we are going to identify our market price of a share. Right. So we have three metrics. How we are going to calculate the market price of a share based on the PE ratio and the other one based on the book value and then based on the price to sale. Right. So these are the three metrics that we are going to have to calculate the market price of a share. You all are 3 to 6 the time slot now. Right. Okay. Anyway, you are laughing. I feel very happy. Otherwise, you are feeling more than the last lecture. Anyway, right? Price to earning multiple. What we are considering here. Okay. Go to the formula here. Price to multiple, price to earnings, right? Price to earnings. What denotes the earnings of the company? Which metrics denote the earnings of the company? It is the earning per share, right? Here what we are going to calculate, we compare to the earning per share and then based on the average or historical PE ratio, what would be the market price of the share? That is what we are going to discuss. So calculated here. So what is the comparable here? What's the comparable? Earning per share. That's a comparable. If we have this kind of earning per share and then we already have the historical value, what would be our market price? It's very easy, simplified method. Right. Okay. Example number 8. Read the example number 8. Okay, the common share is currently traded at 80 rupees and then the historical average PE. What do you mean by PE? Price to earning ratio is 10. It compared the market price of a share and then the earning per share, it gives us a 10% PE ratio. So then number of common shares, that is 3 million. We have now 3 million shares plus the financial year profit is 22.5 million. This year we have the 22.5 million and then we have the number of shares 3 million Our P ratio, historical P ratio is 10%. If it is so, how you can calculate the market price of the share or else the value of the share, value of the common share? Okay, try to do it first. I will give a one hint. We have already calculated that one or else identified that one also. EPS equals net profit divided by the number of shares. Okay, write it down. EPS, earning per share. For a second, per earnings per share. EPS, earnings per share equals net income. Earnings per share equals net income. Net income divided by number of ordinary shares. Number of ordinary shares. Okay. Then write it down. PE multiple. Write it down. PE multiple. Second line, PE multiple equals. PE multiple equals share price equal share price divided by EPS. PE multiple equals share price divided by the EPS. Share price divided by the EPS. Okay, now it is very easy. What's the earning here? Net earnings. Financial year profit, net earnings or net income divided by the profit. Reported earnings. How much is it? 2.25. 22.5. Okay, calculate the EPS first. EPS equals 22.5 million divided by 3 million. That's equal 19. So that's 19.70. 7.5. 75 remains 7.5. Okay. Now, PE ratio, how much is it? 10%. PE equals, first we can call it as share price. Share price divided by it is 10. We don't know SP, and then we have already calculated the EPS, that is 7.5. So then share price equals 10 multiplied by 7.5, that is 75. What's the market value there? Sorry, what's the share price? Value of a share That is what? How much? 75. Now currently the share is trading at the value is share is trading at 80. So then what happened to the share? Is it fairly valued or it's overvalued or undervalued? Overvalued. Why? The real value is 75, but it is trading at 80 rupees. That means even the trade price is higher than the real value of the share. So therefore, that is overvalued in the market. Any question on this one? The other one. The other multiple, right? The other multiple, what is it? Price to book value multiple, right? What is it? Price to book value multiple. In this multiple, what it compares? Share value and then the book value per share, right? Share value and the book value per share. Okay. Accordingly, price to book value ratio identified. Stock price divided by the book value of the share. Book value of the share. Okay. Question number 9. Note එක you කරගෙන ලියාගන්න දැන් මම මේ දෙවෙනි සෙක්ෂන්. නැත්නම් ඒගොල්ලෝ තෝල් note එකක් ගේන්න. Okay. Price to book value multiple. Make the heading price to book value multiple. 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 Next slide. Next slide. PBV, price to book value, right, equals share price divided by book value per share. Divided by book value per share. Book value per share. Okay, now read the question. Marks PLC, their past average price to book value ratio is 9 and then book value of the equity as per the most recent financial statement, that is 18 million. Outstanding shares 1.5 million and then the current market price is 100. So you have to identify the common share price. Okay. Book value per share. How you can calculate the book value per share? Okay, tell me based on the EPS ratio, tell me how you can calculate the book value per share. Again, book value per share, very good. That is total, how the better total equity divided by the number of ordinary shares. Number of ordinary shares. Right. Okay, we first calculate book value per share. Book value per share. Per share equals total book value of the equity total book value of equity divided by Number of coordinations. In the given example, how we can calculate value per share? It's 18 million divided by 1.5 million. What's the book value per share? So with that knowledge, we'll calculate the value per share. We have the PBB equals share price divided by value per share. Share price, we don't know value per share, that is 12. Share value, that is 100 each. Right. If the market identified the value of the share as 100, is that overpriced or underpriced or fair price at the market? Yes, exactly, that is underpriced at the market. Why the real value is 108, but it is trading at 100 rupees at the market. So therefore, at the market, that is underpriced. Okay, fair na dekh. Okay, let's have those who got the concept. Underpriced. Fair unaya dosan balan. Raise your hand, those who have identified the underpriced, undervalued concept. Okay, good. Those who can't understand that one, raise your hand. Underpriced. Okay, right? The real value is 108. Real value is 108. Trading at 100. So therefore, the real value of the price is higher than the trading price. So therefore, at the market, what happens? That is underpriced. Real value is actual value එක 108 වෙන එක 100ට පිටිනවා කියන්නේ so that is underpriced. Right. Okay. So which approach is best? We have two methods. Out of these two methods, which approach is best? Second method. Let's see C. Let's see C. But the first method, let's identify the most. How we can identify which approach is best? So how we can identify which approach is best? So that is based on the organizational choice. Even the second method is really easy, but first method identify most comprehensive concepts such as the dividend growth rate and the time value of money, etc. So therefore, the first method, DDM model, give us the real value of the share, whereas the PE also very good, price multiples also good, but that is very simplified and then limited factor evaluations in the PE multiple the method. So therefore, so we can't rationalize like that. So what happened? Based on the company's evaluation policy, they will decide which approach we need to apply when we are evaluating our ordinary share. So therefore, which method is best will be answered by the company's financial manager according to their perceptions and the prevailing valuation. Okay, that's the end of the valuation of the ordinary shares. Any question on the ordinary share valuation? Any questions on the ordinary share valuation? Common shares or common stocks? Equity shares. Okay, hope you don't have any questions. So therefore, we'll go to the third part of this lesson, that is the preference share valuation. Preference share valuation. I hope the flow is very clear to you. We first valued the bond value. We did the bond valuation, and then we come to the security valuation or share valuation that include ordinary shares and the preference shares. We completed the ordinary shares according to two models, but those two models, price multiple model and the other one dividend discount model. Now we are moving towards the preference share valuation, right? So what do you mean by the preference share? Yes. Preference shares. We compare the ordinary share. So what is the most specialist characteristics in the preference share? They very good. They don't have the voting power, but they have a privilege, that is the fixed dividend, right? So therefore, preference share valuation most similar to the bond valuation. Why we can do like that? So because the ordinary share, the preference shares plus bonds also having same dividend. For the preference shares, we are going to have the fixed dividend. For the bond valuation, we have the coupon payment, fixed coupon payment. So therefore, by considering the future cash flows, basically intrinsic value principle, we can calculate the preference share values also. But the thing is, we have two preference share types. The first one is what do you mean by the preference shares? What are the types of preference shares? Preference shares can be divided into two. Yes, preference shares can be divided into two. What is the first one? Yes, preference shares which has a maturity, the other one, preference shares which don't have the maturity, right? Some preference shares, what do you mean by the maturity? That means the shareholder is going to keep this or hold these shares for a specific period. At the end of that period, what happened? We need to redeem the shares, right? Company need to redeem the shares. Accordingly, we identified the preferred stock with the maturity as the redeemable preference shares. Varaniya nidahas kala hai. Varaniya potas kala gana preference shares वलට nidahas kala hai varaniya potas. Right? That means preference shares with the maturity. Right? Normally, this one is most probable. This is similar to the coupon bond valuation. Right? Tell me regarding the valuation, what is the base? Intrinsic value. Right? What do you mean by this? Is really easy lesson. Right? So what you need to understand is the basic concept. Right? Each and every valuation is based on the intrinsic value. What do you mean by the intrinsic value? Present value of future cash flows. Now, this third step, you need to identify regarding the specific bond, what are the future cash flows? So, regarding the specific security, what are the future cash flows? Now, tell me if it is a preference shares with the maturity. From the investor's perspective, what are the future cash flows? Yes, you are going to have the dividend. Preference shareholders, do they have a fixed dividend? Yes, exactly. Right? Even the share price changes, they are going to have the fixed dividend. Definitely similar to the coupon payment. Is the coupon payment is going to change during the maturity periods? No, it's not. So therefore, what happened in the preference share valuation? Same condition that we have applied the coupon bond valuation can be identified here. right? Why? So this is the part of the total future value, present value of future dividends. Where we have identified in the bond valuation present value of all two machines. Did you remember that one? Right. Second part, this formula again includes two parts. The first part, what is that? Present value of all future, present value of all future fixed dividends, right? The other one, second part, that is the present value of, what is that? Present value of, what do you mean by RP? Redemption price, right? Redeem price, or else at the end of the maturity period, how much amount that the invested person is going to have. That is called as a redemption price. It has certain value, right? Therefore, you have to identify this redemption price exactly after 5 years, after 10 years, after 20 years. Again, what you need to do is you need to convert this redemption price to the present content. So therefore, divide the redemption price by 1 plus R to the power the maturity period, that is NP. Any question on this valuation technique? No. Example number 9. I have 3 hours period for the business finance lecture, so therefore, when I'm explaining the concept, you need to write. Otherwise, I don't have the time to give. I don't have the time to give the time to write it down. පොඩ්ඩක් accelerate කරලා කරගෙන යන්න ඕනේ. ඊළඟ දවසේ lecture එකට hand out print out එකක් අරගෙන මේක හරිම ලේසි මේ වැඩේ. ගාන කියන තැනම හදාගත්තා. එතකොට ඔයාලට ෆෝමියුලා ලියන්න වෙලාවක් යන්නේ නැහැ. මම දන්නේ ඔයාලා අනිත් lectures වලට hand out ගේනවා කියලා. කොහොමද? මට තියෙනවද? ඔබ උතන හදාගන්න ගාන ෆෝමියුලා ගැටි හදාගන්න. ඒක හරිම ඕක ගොඩාක් ලොක් කැල්කියුලේෂන් දෙමේ කොහොමද දෙන්න hand out. Okay, right. Oh, recording. Print out तो करेगा ये value is the face value of that and the preferential. Normally the redemption is at par value. You discuss with your friends and do it. Now I can check whether you have the proper idea regarding open board valuation also. According to the way of applying this question. If you can identify or if you can value the preference share correctly, so then you are super bad preference share evaluation plus code valuation. For the preference shares, the normal retention price is par value. Par. Dividend fixed number. We have power can Anyone who calculated the value? Then yonder open conference or first last week में पटांगा था और नील पे draft का करला आठने लाइक अन्ने नोट करने दे अन्ने नहीं सरला नोट पे लंच सरला इंटरेस्ट रेट रिस्क और आइडेंटिफाई करा मत करें ग्राफ एक ग्राफ से थोड़ा सा ना आपने कूपन पेमेंट गवर्नमेंट करे कौन मत कीजिए It's correct. Car value 100 multiplied by 10%, that is 10 rupees. You are correctly calculated it 10%. That's okay. The thing is, you are getting 10. During this 12 years, you are going to have the 10 rupees. What is this? This is the annuity. Therefore, value of the preference share equals sum of dividends during the T number of period divided by 1 plus R to the power T. Right? How you can calculate this part? It's become the annuity. Same amount during 12 years. So therefore, dividend multiplied by the annuity factor. How you can calculate the annuity factor? It was Yanba value exam right. Okay, guide you again. 1 minus 1 divided by 1 plus R to the power N divided by the required rate of friction. This is one the annuity factor. Dividend, how much is it? 10. Annuity factor. 1 minus 1 divided by 1 plus R. How much is the R? 0.11. 0.11. During how many years? How many years? 12 years period. 12. Divided by 0.11. Okay, you can do it 0.11. Calculate the annuity factor and tell me. This is what? This is the present value of all dividend payments plus. Are we going to only have the dividends for this month? Are we going to have only dividend for the person during these 12 years? No. So then what is the last payment that we are going to have? Redemption price. Redemption price. So therefore, the other part, redemption price. Redeemment par. Redeemment par. What's the par value? 100 rupees. Right? 100 rupees. This par value occurred at which year? Which year? According to our timeline, we are going to have the dividends. And then at the end of the 12th year, you are going to have this. You are going to have this 100 rupee redemption price. So therefore, if you are converting this 100, it should be multiplied by 12 times. So therefore, 1 plus 0.11 to the power 12. Right? You can separately take the value here. What is this one? This is what? Present value of redemption price. It's very basic. Both together, what is this? The value of the share. Regarding the preference share, we have two values. Again, two cash flows. The first one, what's the first one? We are having dividend. The other one, regarding again preference share, we have the other cash flow, that is redemption price. Both together, the present value is one, the value of the preference share. Now I hope it's clear to you. Same as the bond valuation. Nothing changing. Again, okay? Okay, what is this one? What's value here? 10 multiplied by the annuity factor. 60. 64.9 plus. The next part, what is it? Present value of redemption price. How much is it? 28.58. Both together value 93.50. Okay, that's 3.507. These are the dividend for dividend payments. 12 years, during 12 years. During. අවුරුදු 12ක present value එක ගන්න කාගෙද? dividends වල. ඔයාලා හැමෝම අරන් තිබුණ වැරද්ද කරලා තිබුණේ ඔයාලා last year dividends වල present value එක අරගත්ත හින්දා. ඒකයි වැරදිලා තිබුණේ. නෑ අපිට ඕනම cash flow එකක් annuity එකක් නෙමෙයි එකම cash flow එක අවුරුදු ගාණක් එකපාරක් හම්බ වෙනවා නම් අපිට ඉක්මනට present value එක convert ගන්න එකින් එක ගන්න ඕනේ නෑ. ඇයි හේතුව එයා annuity එකක් වෙලා නිපේ. ඒ නිසා ඉක්මනට මොකද කරන්නේ? annuity factor එක ගන්නවා. එතකොට preference share valuation වලදී dividends fix. අවුරුදු 12ක් යනකම්ම dividend fix. Coupon payment එකක් හම්බෙන්නේ dividends වලට ඒ යන අවුරුදු ගාන maturity period එකේදී මොකද වෙන්නේ? Coupon payment එක fix. එහෙනම් annuity එකක් annuity formula එක apply කරා නම් හරියි. Right. Okay. What's the value there? 93.5. Right. Okay, so then we'll go to the other part. Then we are going to now. Okay, the last one. That is perpetual preference shares. Right? That means perpetual. What do you mean by perpetual? Yes, it doesn't have a maturity. Right? So therefore, in this set of the preference shares, it don't have the maturity period. So therefore, we technically call them as irredeemable preference shares. Right? We can't redeem those things. So those are irredeemable preference shares. Right? Okay. If it is a irredeemable preference shares, do we have a redemption price? No, we don't. This is what, again, this is a perpetual preference shares or perpetual preferred stock. If it is a perpetual, what it means, it doesn't have a maturity. Right? It doesn't have a maturity. If it doesn't have a maturity, we call them as technically redeemable, not redeemable. That is a irredeemable preference share. Redeemable preference share. Right? If it is doesn't have a maturity period, do we have a redemption price? It doesn't have a maturity period. Therefore, we don't need to take the present value of the redemption price. Plus, we don't know the time period that we are going to hold this preference share. Therefore, we can't take the dividend divided by 1 plus r to the power n. Why? We don't know the n value there. We don't know the maturity price. Sorry, we don't know the maturity here. So therefore, what we can do is value of the preference share, if it is the irredeemable one, equals dividend divided by the required rate of return. It presents as the real value of this preference share. Right. Okay. Question number 10. We may do it. It is 15 dividend for the perpetual preference stock, and then the par value is 10. Suppose that the required rate of return is 10%. What's the percent value of the stock? How you can calculate dividend divided by the required rate of return? Dividend, how you can calculate the dividend? 100 multiplied by the 15% divided by 0.1. That means 15 divided by 0.1. That gives us the 151. Okay, normally this set of the preference shares, it gives us the high dividend. Why? It doesn't have a maturity price. If compared to the other preference shares, this set of the dividends, they are giving a huge dividend other than the other set of preference shares. Okay. That's the end of the preference share valuation. With that, we can conclude the lesson. The share valuation or is the stock valuation. Okay. Any question on the valuation lesson? Okay. Any questions on the valuation? Any unclear points? If you don't have any questions, do you have any unclear points on the valuation? We have identified the bond valuation. Basically, the valuation lesson covers the one valuation and second valuation. One valuation, we have identified three set of bonds. But those are poor discount bond, coupon bond, and the other one perpetual bonds. Right? And then we identify how you can calculate what is the interest rate relationship or else interest rate risk, and then we identified the method of valuing the trading price of the bond as the last part of that question. So then we came to the share valuation. It includes two components: preference share valuation and the ordinary share valuation. Right? Ordinary share valuation, that's based on the dividend discount model, and the other one price multiples. Dividend discount model based on the holding period as well as the based on the dividend growth rate, we can identify the bed valuation techniques. Under that one, we identify the differential growth rate, zero growth, constant growth, and likewise. Next one, preference share valuation. It includes the two set of things. That is the preference share valuation, which has a maturity time, maturity value for its maturity, and then which doesn't have a maturity. That is what we have discussed under the valuation lesson. Hope it is very clear. The flow is very clear. So then we move to the other lesson after having a 5 minutes break. Count at 10. Sorry, 5. Start 5. Start at 5. Code from India. Already വെട്ടിയില്ലേ? അതിൽ For this question, answer for this you all have investments. Yes. Okay, write down. Okay, take out the pens and write it down. What are the investments you have? Yes. Write it down. What are the investments you have? There are no investments. What are the investments you have? Very good. Fine. So we have invested on the degree, right? How you can define that one as an investment? Yes. Can you identify it as an investment? Yes. Why? You have already sacrificed for the movement. I hope you may even have your whole life yearly. So with the expectation of what? With the expectation of future economic benefits. What may be the future economic benefits for your degree? High salary. Yes, high salary. Right? Or else sometime if you are doing a job, you might get be a promotion. Right? Sometime if you don't have a job, this degree will be a valuable addition to have a job. Or else provide you the opportunity to have a job. So therefore, we identify. So doing a degree at sub-campus, what is that? That's an investment. That's an investment. Okay. So therefore, I hope even you don't have any financial investment, you have a one investment. What is that? Invested in your degree program. Right? So with that, we'll identify the lesson today. That's the calculation of risk and return of the investments. Right? Risk and return of the investment. So this is highly technical lesson with combined with the statistics subject. So I can't exactly remember the lesson name. So in here you have to identify the standard deviation calculation, coefficient of variation, all the technical terms that you have studied in the statistics subject applied here. Right? Okay. But very interesting, right? So we are not going to have the entire calculation here as it is. What we are doing is we are combining the finance concept with the technical terms and technical models. So that is how we are going to have the risk and return calculations. Very easy, right? So we are not going to have the we are going to apply the finance concept to the mathematical calculation or statistical calculation. That's it. Okay, risk and return. So these are the some of things that we are going to discuss. Right. So what is this about? Yes. Inflation. Okay, good. What else? What is reflect? Yes. What happened with the time duration? The money is going to be changed. I just included this one as a picture of for the investment, right? To identify the what do you mean by the investment, right? So with the identification that we have done in the first slide, we'll come up with the technical definition for investment. Before moving to the calculation of risk and return, we need to identify what do you mean by the investment. Right? Why do we need to consider the investment? We are receiving the risk and return on which one? Based on the investment. So therefore, you need to first identify what you mean by the investment. Right? What is investment? Sacrification of the current funds for what? For the future economic benefit, or else sacrification of current funds with the expectation of future economic benefits. Right? So why the investors are expecting the future economic benefits? Why we are investing 100 rupees today? Are we expecting the same 100 rupees after 5 years from now? No, we don't. Why? Why we are expecting something more than the investment that we have done? Exactly because of what? Because of the inflation, and then we are going to sacrifice some money for the some certain period. In that certain period, there may be some uncertainties, as well as we are going to sacrifice something today rather than investing the same amount in the other places. Therefore, we have the opportunity cost. Right? So therefore, we are maintaining an investment with the expectation of the future income, which is higher than the today's committed funds. Right. Okay. With the investments, right? With the investment that we have done, so we can identify the concept of risk and return. What are the investment? What are the investment opportunities do you have? As a rational investors, now we move towards the bit technical terms and other things. From the campus and degree, we'll move to the normal investment. As a rational investor, what are the investment you have? Whereas what are the investment opportunities you have? Share investments. Very good. You can invest in the shares. For the moment, you can buy shares. If you open the CDS account and then go to the broker, if you are dealing through the brokerage company, you can purchase the equity shares. Not only the equity shares, the preference shares also. What else? You can purchase the government securities, treasury bills, treasury bonds, and etc. What else? FD is okay, fixed deposit. What else? You can invest in the corporate debentures, the corporate funds. Again. Maturity. Mutual funds. Mutual funds. Okay, man, you can invest in the money market in these identified securities. Good. So all the financial securities, financial instruments are traded in the money market. We have to go to the money market and invest in these securities. Good. Right. So these are the sum of opportunities we have to make our investments. Right. If you're doing an investment, definitely you have the return. You are expecting return. That is why you made the investment rather than keeping the money in your hand. With this return, right? With this return, do we have a risk? Yes, exactly. Right? If you are having a return, definitely in return you have to suffer the risk also, or else you have to bear the risk. Right? As a rational investor, when you are making the investment, we are not going to just invest in by looking at the return of that investment. Right? What you are doing is you need to consider the risk versus return, or else we call it as a risk return. We need to make the risk return trade-off, and by considering the risk versus return, you have to place your investment. Otherwise, you are not a rational investor. Right? Okay. So with the return, what happens if the returns goes up? What happened to the risk? Risk also high. If the returns go down, what happens? Risk also very low. So therefore, we can identify what sort of a relationship in between the risk and return. Exactly, there is a most probably in the cases we are identifying the risk versus return are having the positive relationship, not the negative relationship. Right? I will just give example to you. Did you remember the Sakwiti? Yes. What happened? Most probably it may be more than 10 years or 12 years back. So what happened? Rather than investing in the banks, what people did, they invested in where? In the Sakwiti's place. Where in that era, he gives the 20 or 25% return rate on the investors' funds. Rather than in that data, the banks may be given 10 or 8% interest rate. What happened? Individuals, they have taken a high risk. Meanwhile, what they receive? A high return. Right? So therefore, always, if the return is high, definitely risk also high. If the return is low, the return risk also low. Right? Now we'll take the treasury bonds and the share prices. Right? If you invest in the treasury bonds, right? What may be you're having the return which is lower than the equity shares return. But when compared to the treasury bill return, what happened to the equity shares return? That's very high. Now the risk. If you are investing in the treasury bills, how much may be your return? How much may be your risk? Definitely lower than the equity shares. Why? You are investing the government treasury bills or treasury bonds or whatever the security. So where the default risk is zero. But if you invest in a company shares, what happens? You are taking a risk. Sometimes if the company collapses, you won't be get the funds again. So therefore, you need to understand there is a positive relationship between the risk and return of the investment. Plus, as a rational investor, when you are making the investment, you need to consider one risk versus return. Okay, we'll first identify the concept of return. Now make the heading risk and return. The main heading risk and return. Lesson number 3, 4, 5. Lesson number 5, risk and return. Risk and return. Okay. First one, calculation of risk. Or let's make the heading risk. First, return. We are starting with the return. Sorry. Return. 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 We basically calculating the return of the securities. That means shares, ordinary shares, right? Now we are focusing the investment in the shares. From if we invest in the shares, what would be our returns? That is basically discovering about the risk and return of the securities or shares. Right. Okay. If you invest in the shares, in return, what are the things you can get? We recently discussed that one. If you invest in the shares, dividends. Exactly, very good. That's the dividend. One thing is dividend. What's the other one? Very good. That is the capital gain. Right? You purchase, just assume you purchase one single share, 100 rupee, and then hold that share for a 1 year period. At the end of that financial year, you sell the asset, you sell the share for 150. And then at the end of the first year, you get the 10 rupees dividend. What would be your income? Or else what are your returns? The 10 rupee dividend, that's the dividend, that's the income in the form of dividend. And the other one, you purchase the share for 100 rupee, but at the end of the 1 year period, you sell the asset for 150. The difference between 100 and 150, that is 50 rupees. What is it? That's the capital gain. Right. So therefore, you have to, this is very basic. You have to understand, if you invest in a share, you are getting the two type of returns. First one is the dividend, the other one capital gain. Right. Normally, returns are expressed as in the form of ratio. Right? Ratios. To convert this earn, dividend, and then the capital gain, how you need to present it in the form of ratios. How you convert this earn, capital gain, and dividend to the ratios by dividing these two components with the acquired price or as the purchase price. That is what here I have mentioned. Dividend return equals, regarding the shares, return equals dividend plus the capital gain. What do you mean by PT? At the end of the T period, what would be the selling price of this share? P minus 1, that means acquired price. The difference between purchase price and then the selling price, what would be this? This is the capital gain. By converting this dividend and the capital gain both together, the return, the percentage, you can divide this both by the acquired price, purchase price. That means PT minus 1. So this is the normal formula, general formula to calculate the return of the individual security or a share. Okay. Okay, the other one, holding period return. What do you mean by holding period? The number of years that the respective investor hold the investment, right? So in here, what we are going to calculate, if you invest today, right, and then you are getting the income after 5 years, after 10 years, what would be the entire period or else entire holding period return? How you can understand or else how you can calculate the entire holding period return? You are getting the ending value of the investment. Dividing it by what value? Which value? The initial investment. So then you can get the other one, holding period return. Holding period return. What do you mean by holding period return? Again, you have invested 100 rupees and then at the end of the financial year, you are going to have the 150 rupees. So then what would be the holding period return? 150 divided by 100. How you can convert it to the yield? Yield means a ratio. We have calculated with one yield to maturity. Did you remember that one? With the IRR, we have calculated the yield to maturity. Right? No. Right. Anyway, right? How you can convert this acquired holding period return into the yield by the calculated holding period return value U minus 1. So then it gives us the ratio or else yield. Okay. The next one, annualize or else annual holding period return. Holding period return identified after 5 years period, after 10 years period, after 20 years period. What would be within this period? What would be your holding period return? Annualized holding period return, that it reflects annually how much of holding period return that you are going to have. අවුරුද්දකට කීයක් හම්බ වෙනවද කියන එකයි මේ annualize එහෙම නැත්නම් annual holding period එකෙන් calculate වෙන්නේ. Right. Okay. Again, annual holding period return equals holding period return to the power 1 over n. Right. That means why we are taking the to the power 1 over n, it gives us what? Annualized amount. Again, to convert this annualized holding period yield return into the yield, again, from the calculated formula U minus 1, that gives us the percentage. Right. Okay. Very basic things. Okay, we'll do the question number 1. Okay. This is just an investment that costs 250 and it burns 350 after being held for 2 years period. That means holding period is 2 years now. You have invested 250 and then you receive 350 after 2 years. How to taking first we are common another 350 after. Right. What's the first one? Calculate the holding period return. Holding period return equals. Holding period return equals ending value. How much is the ending value? 350. 350. The amount that you have invested, 250. Holding period return, 1.4. 1.4. If you identify the holding period yield, the other one, holding period yield equals holding period return minus 1. Return is 1.4 minus 1, that is 0.4, or else that's 40%. You have invested 250. Over this 250, you earn 40% return. Okay. The next one, annualized holding period return. You have invested this amount for 2 years. If it is so, how much is the annualized amount? Annualized amount. We have 41 students then. That means there should be 41 sites. Marking sheet, when you are marking the attendance, there should be only 41 attendance. Okay. That's okay. So then, annual holding period returns. Annual holding period returns. Yes. How you can calculate? Yes. We have the holding period return. That's for the entire 2 years period. HDR. This is for 2 years, 0, second year. Now they are asking annually how much you are getting. It is identified as the annual holding period return. Annual holding period return equals holding period return to the power 1 over n. Holding period return 1.5 to the power 1 divided by 2. What's the value? 1.18. 1.18. Right. So then how you can convert the return to the yield? Annual holding period yield equals annual holding period return, annual holding period return minus 1. 1.18 minus 1, that means 0.8, or else 88%. 18%. One divided by 2. Okay. Question number 2, that's for homework. So then the other one, average rate of return. What do you mean by average? Now we are going to calculate with the rates also, right? Average rate of return. Average rate of return, what is that? How much is it? How we can calculate? Sum of variance, one period rate divided by the number of periods that you have invested, right? Average. What do you mean by average? Average. How you can calculate the average? Well, it's total or a sum of the given values divided by the number of years or the number of the amounts that you have been given as the basics, right? In here also, if you have been given the rates or else return rate for several years, how you can convert that one to the average value? Take the total returns divided by the number of years. R bar. With the same one, example number 3. What you can do is you can view the tutor via mobile and then no need to write the formula. You go to the question, when you are writing the question, you write the formula then. So then otherwise you are writing the formula in 2 times. That's a waste of time. R bar average rate. R bar or else you can name it as like this. This one we have calculated average return. When it comes to statistics, you have calculated average values. Now we are calculating average return. Average return. Very basic class. This need to be always identified because why when you are calculating the risk, this is the foundation. This is the foundation for the formula. Right. Okay. Read the question. The following are the annual returns of an investor who purchased shares from Sampat Bank. Right? Or a Sampat Bank return for the 5 years period given to you. What you need to calculate is the average. What is that? Average. Got the calculate one average rate of return. Asal. How you can calculate the average rate of return? Take the total. How much is the total, Jamon? R y equals sum of returns divided by number of years. Sum of returns. Sum of returns 48 point. Did you consider the minus as well? You need to consider the minus as it is. Otherwise, don't take it as a +1 and add it. That's wrong. If you are doing that like that, that's wrong. Take the total of this 5-year return. That is 48.4 divided by 5. 5. Some more. Why we are doing to divide it by 5? Very good. That's 5 years. What's the value? 9.68. Okay. Next one. Now discover. It's very easy. How you can measure the risk? We can calculate the holding period and then the whole annualized holding period return, and then we can calculate the share return. That's R equals dividend plus the capital gain divided by the purchase price, and then the last one we identify the average return. That means total returns divided by the number of years. Now, next one, risk. Make the heading risk. Right. Okay. Make the heading for the risk. Now we are going to identify the risk. Okay. What are these figures? Shares. Which shares? Sampath Bank. Right? Sampath Bank shares from which year to which year? Or from October to September. Right? So you don't need to consider the open market 5 years low to other things that what you can take us. Just consider the prices. That. What happened to the prices? So these are the prices of Sampath Bank. Increase. Yeah. Increase. Constant and likewise. You can identify several patterns here. Okay. So this is what dividend pay, DPS. Right? For how many years? For 6 years period. 2019 to 2025. Right. Consider the dividends. Increase, decrease, and likewise. So what I want to explain you, if you invested in a common share, if you invested in a shares, what you are getting now is the capital gain as well as the other one, but it's in dividends. But as an investor, can you receive the same thing that you have expected? No, never. What happened? These selling prices always change as well as the dividends always change. Or else the expected dividends are not going to be always received for the investor. Plus expected selling price also never occurred as per the investor's perspective. But we are identifying there is a volatility or else variation in where in the return that the investor expects, which is linked to where to the risk. Right? That is why the concept of risk has been identified. Why the risk has been identified? Always the investor's expected income is variant with the time period, or else has a volatility in the change. Right. Okay. So then you have been given the details here, the variation of return. Right? Or else volatility of return is the cause for the calculation of risk. Okay. That means your actual return on the investor may be substantial from your expected return. That means always as a rational investor, you are not getting what you are expecting. Right. Okay. Now thinking, if you are going to calculate the variation, what is the basic statistical calculation to identify the variation? Standard deviation. So therefore, risk is calculated with the standard deviation. Risk is calculated based on the standard deviation, right? Before moving to the calculation of standard deviation, what you need to identify, Hassan, the variance between the real income that you are receiving with the expected return of the investor. So that is how you can identify the variation. Then risk බලාපොරොත්තු වෙන දේ හැමතිස්සෙම හම්බ වෙන්නේ නැති හින්දා තමයි රිස්ක් එකක් ඇති. එහෙනම් රිස්ක් එක අඳුනගන්නේ කොහොමද? ඉස්සෙල්ලා අඳුන ගන්නවා කොහොමද? The difference in between what? The expected return as well as the average return that you are getting on with the other one, the actual return. Right? So then it leads to the variation to make the minus and plus things all to the same format. What we are doing is we are going to take the square root of the differences and then take the total of these differences and we name it as one, the variance. Right? So then standard deviation calculation based on the square root of the variance, which is identified as the standard deviation. Standard deviation equals what? The square root of the variance. Right. And then coefficient of variation we identify later on. Okay. Quickly consider the given question. Okay. With that one, calculate quickly. First one, calculate the average return. Copy this one to your books. Consider the following two securities which named as the S and C. Right, security names or share names, they are S and C. Okay, so then past returns 2020 to 2024 returns were given to you. Okay, you copy this table to your formula. To your books. So this is what we are going to do. I hope you all can remember the standard deviation calculation and other things. So these are the returns of the S and then return of the C. I just calculate the return. Right? Average return. R bar. R bar. R bar for what? For the S. Now you can take the R bar of S. Take the total divided by the number of years. Can we get the total here quickly just to finish up your lesson? 8.5, 12, 13, 9, 10. Huh? 40. 54.5 divided by 5, 4, 3, 2, 1. How many years? 5 years. What's the average return for S? 10.9. The other one, R bar for the C equals total of the returns for the C divided it by the number of years. 9 point total is about 9.6. Total 46. 46 divided by 5. That is 9.9. Right. So with your knowledge, you can now calculate the standard deviation. Right? What's the first task? Difference between the given rate or its given return and the expected or its average return. So what is the first one? 10.5 minus 10.9. Right? The other one, 8 minus 9.4. Take the square root of these values and then take the total, that is variance. And based on the variance, take the standard deviation and calculate. Take the standard deviation, calculate the standard deviation as a homework and complete it and come to the next week. It is clear?
Yes.
These are the very basic things. And very easy.
You update the limit?
வேலை எடுத்து
They are only 41.